Thanks for clicking. The Bank of Canada is going to have to cut interest rates before the Federal Reserve amid a weakening economy and to provide some offsets for the upcoming mortgage renewals in 2025 and 2026. This according to Phillip Colmar, chief strategist at MRB Partners.
That's just a straight shooter with upper management written all over.
Indeed, Colmar made widespread headlines in the summer of 2023 for saying that Canada was sitting on one of the biggest housing bubbles of all time.
And that, sir, is an idiot.
However, Colmar now says that housing market is being propped up by a strong economy, and if that economy starts to turn, the bank could be forced to cut rates before that of the Federal Reserve. And Colmar was not the only one, with the media and a number of economists arguing that the rise in the unemployment rate from 5.8 to 6.1 in March raises the chance that the bank will be cutting rates as early as June. However, Doug Porter from the Bank of Montreal, famous for calling nonsense on the argument that the pandemic price boom was due to supply and not due to free money, says that the unemployment data is putting the Bank of Canada in what Porter calls a tricky spot. So what I want to do today is go over Colmar's interview with Bloomberg, take a look at why Doug Porter says the unemployment data has the Bank of Canada in a tricky spot, and then try to put everything together to summarize the choices available to the Bank of Canada at their upcoming meetings. The Bank of Canada is set to make its next policy decision this week on Wednesday and a press conference to follow thereafter, and we'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. On to Colmar's interview. As mentioned, Colmar had noted and made widespread headlines in the summer of last year that Canada could be sitting on one of the biggest housing bubbles of all time. And now, Colmar says that with unemployment rising and the economy weakening, the Bank of Canada could have to cut rates to keep everything from falling apart.
And the thing that's been holding it together has been a durable employment picture. So this is 1 month. I don't want to discount it that there's the beginning of a big trend, but the Bank of Canada does need to take note. If that starts to go, that's the thing that's holding housing and everything together when you're dealing with really painful mortgage resets. We've been arguing the BOC needs to offset those, but if employment starts to fray, they're going to have to offset it pretty fast.
And yeah, we've talked about this before, with RBC noting that in 2025 alone, about $315 billion in mortgages are set to renew at higher rates. And while we have seen rising mortgage delinquencies on the part of Canadians, we haven't seen that hit crisis levels as of yet. And Colmar says that is due in large part to the strong economy. However, with unemployment rising from 5.8 to 6.1 in March, we could be seeing the Bank of Canada having to cut rates before that of the Federal Reserve.
The BOC needs to not think of it in the context of the U.S. The U.S. is in good shape, has solid foundations. Canada has pretty leveraged foundations here, so needs to consider it differently. It's been watching that timeline of the Fed, but I think it's going to have to go earlier and certainly have to cut rates in order to provide some offset to those painful mortgage resets.
Yeah, that will definitely be a popular sentiment. But Colmar is not making the point that those homebuyers from 2020 and 2021 who bought at ultra-low interest rates and ultra-high prices need to be bailed out. What he is saying is that Canada is in such a position of high leverage, in such a position of high household debt, including that of mortgages, that if we have those high rates combined with the high amount of household debt, in conjunction with a weakening, maybe even worsening economy, everything could very well fall apart.
What's the difference?
And we've talked about the link between the unemployment rate and the Bank of Canada before on this channel, in that for the past 50 years, the Bank of Canada has not ever, not once, lowered rates when the unemployment rate was below 6%. But, says Colmar, while the central bank may be in a position where it needs to cut, not necessarily to bail out those mortgages coming for renewal in 25 and 26, but to ensure that those renewals don't come amid a tanking economy, the United States is in a very, very different position.
All fronts, the U.S. economy is strong. It's not just the employment. The spending picture is strong. Consumer confidence is still durable, at least at the present situations of it. You've got the service sector's resilient. You've now got manufacturing bouncing back up, and you've got housing starting to refirm. So there's really no case on the economy front for rate cuts. It's really a policy mistake to do so.
And yeah, we received reports coming out of the US on the same day that Canada got its unemployment data, showing that the US added 303,000 jobs in March, while Canada lost 2,200, leading some to argue that the Federal Reserve might not even have to cut rates at all this year. Yields were up on 10-year U.S. Treasuries as traders pared back their bets that the Federal Reserve would be cutting rates imminently, and in a testament to which country's data matters for the future of Canada's economy, our own yields ended the day higher than that which they started. even with investors pricing in an 86% chance of a rate cut come June.
The one who calls the shots.
Yeah, and we've discussed this so many times on this channel. This is a problem for the Bank of Canada, as bets that the bank would be cutting rates before that of the United States sent the value of the Canadian dollar falling. If the Federal Reserve is going to be keeping rates higher than that of the Bank of Canada, meaning the US government, which issues the safest debt in the world for now, is going to be paying more in interest than that of the Canadian government, then there's going to be more demand for US dollars, as investors need US dollars to lend the US money. Meaning lower Canadian interest rates means less demand for our dollars, lowering the value of those dollars. But what that also means is that a divergent interest rate policy can and will drive up the price of goods, as everything we import will get more expensive. So we have Phillip Colmar saying that the Bank of Canada is going to have to lower interest rates in the lead up to 2025 and 2026, especially in the lead up to those mortgage resets. But, as we've talked about before, doing so will increase the price of imported goods, will increase inflation. And Doug Porter of the Bank of Montreal, looking at the unemployment data, said that there's another reason why rate cuts could be a tough needle for the Bank of Canada to thread. Productivity is not keeping up with wage gains, with the unemployment data showing wage increases of 5.1%. Looking at this data, Porter noted that with productivity barely moving, these 5% gains will feed right into cost and threaten to keep inflation sticky. Yeah, and Deputy Governor of the Bank of Canada, Carolyn Rogers, addressed this idea at a speech on March 28th, noting that strong productivity helps protect the economy from inflationary pressures. If the economy produces more stuff and has the same amount of money, the overall price of that stuff should decrease. In contrast, if the economy has more money and produces less stuff, the price of the stuff that is available is going to increase.
No one told me about this.
And with wage growth coming in at 5%, not to mention the risk of a wage price spiral, this presents a real problem for the Bank of Canada. The Bank of Canada wants higher rates. It wants to increase unemployment. It wants to increase unemployment and reduce the bargaining power of employees to drive up their wages. And while higher unemployment should work to reduce some of those wage pressures, it obviously hasn't done so as of yet. So we have a weakening economy putting more pressure on the Bank of Canada to lower rates. However, those lower rates, if they diverge too much from the Fed, will put upward pressure on prices, upward pressure on inflation. Further, we have the implementation of the carbon tax and growing pressures abroad, both of which could obviously put upward pressure on energy, putting upward pressure on inflation.
This is a nightmare.
Yeah, it's definitely an uncertain time. The Bank of Canada did want to see the unemployment rate rise, which I'm sure it's very happy to see, but it also thought that that rise in unemployment would help to contain wage pressures, which it obviously hasn't as of yet. Further, with the US economy humming along and the Federal Reserve looking less and less likely to be cutting rates anytime soon, this adds another layer of complication for the central bank, which may want to cut rates in the lead up to 2025-2026 amid a worsening economy. But if the Fed is keeping rates high, that will put more pressure on our own price of goods, on our own inflation rate. Doug Porter noted in his statement that the bank will probably shift more to that of a dovish nature, more towards an inclination to cutting rates at its policy announcement this week, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.